Let's see how a spread bet works. First, we'll need to know how to read a spread bet quote. The spread bet quote gives you key information at a glance. If you think the UK 100 will fall in value, you would trade at 6500.5, the sell or bid price. If you think the UK 100 will rise in value, you trade at the buy or offer price, which in this example is 6501.5. Also note that the UK 100 is quoted in pence, not pounds. When you are spread betting Forex, the price is the exchange rate between one currency and another. The first currency listed, in this case the pound, is known as the base currency. The second, US dollar, is the term currency. If the base currency strengthens against the term currency, the market will rise. If the base currency weakens against the term currency, the market falls. In both types of spread bet quotes, the difference between the buy and sell prices is called the spread, which is the commission to enter the trade. The stake is the amount of currency that you bet per point of market movement. So, assuming you have a GBP account, a stake of 1 means that you make £1 for every point that the market moves in your favour. For every point it moves against you, you lose £1. Now, let's talk about how you would actually place a spread bet. Let's say you're interested in spread betting on oil and look at the quote for the spot Brent crude, one of the most heavily traded contracts on oil. Let's say Brent crude is at a bid price of 11500 and an ask price of 11504, and you believe that it is due to rise. You buy at 11504 with a stake of £1 per point. Brent crude has a margin requirement of 1%. 11504 times £1 times 0.01 equals £115.04 initial margin. You check back in an hour and Brent crude has risen to a bid price of 11550 and an ask price of 11554. Your analysis suggests it will continue to go higher, so you decide to see where it is at the end of the day. After a few ups and downs, it rises to a bid price of 11580 and an ask price of 11584. You decide this is a good time to exit the trade and you sell at 11580. Deciding to hold out on the trade paid off and you profit £76 before financing. Let's back up and see what would happen if you were incorrect and Brent crude fell to a bid price of 11480 and an ask price of 11484. You believe that it probably will continue to fall, so you decide to cut your losses now and exit the market by selling at 11480. Your loss would be £24 before financing. The examples we have gone over so far are examples of market orders. Market orders are orders to buy and sell at the current market price. Market orders guarantee execution, but not the price. Direct deal tickets are also offered. These orders guarantee the price, but not the execution. So you have a range of orders that are available to you depending on your trading preference. Stop orders are orders to open a market order when a specified price is reached. For example, if you bought UK 100 at 5779.3, you may set a stop order at 5767.3. If the market hits or falls below 5767.3, you will automatically sell and exit the market. Stop orders are used to minimize your risk. Limit orders are used to maximize your profit. A P&C order, or parent and contingent order, allow you to set up an entire trade strategy, including stops and limits, in just one step. P&C orders are set to OCO. One cancels the other as default. So if your stop or limit is hit, the other is also automatically cancelled. For more information and videos on trading, visit plus.tradefair.com. Forex CFDs, spread betting and options are risky and not suitable for all persons. This video is for education purposes only.